On Tuesday this week, I had a lady who called from Atlanta, Georgia, and she said she's been following my videos. She was trying to find out what is the best possible scenario for her. Her cousin has been trying to influence her to invest into real estate, but then she said she had about $600,000 in her 401k. And she was asking me if the 401k, if it was the best thing for her to keep that money in the 401k or for her to invest in real estate. That's what inspired me for this video today. So the topic today is a very interesting one: 401k and tax-deferred accounts. About 90% of Americans, they have their so-called investments or retirement money stuck up in tax-deferred accounts. I wanted to break it a little further. When we say tax-deferred, in other words, we are saying tax later. In other words, we are saying tax delay. A tax-deferred is not tax-free. Most people confuse this. Let's make it clear. I'm going to give a little analogy from Doc Andrews. Doc says, would you prefer to pay tax on a seed, or do you prefer to pay tax on the harvest? Because on the seed, you are paying tax on one seed. But on the harvest, you are paying tax on the entire big bucket. Let's look at some of the three dangers for your retirement accounts or your investment accounts. We'll talk about taxes, we'll talk about inflation, and we'll talk about the market volatility. Number one, taxes. Your 401k, your IRA, your 403b, or your simple accounts, they are all what we call tax-deferred accounts. You don't pay tax at contribution, but at distribution, that's when you pay tax. Inflation. I remember back in like 2006, 2007, a gallon of milk was like $1.50. A gallon of milk now is almost $5. Your retirement account should outperform inflation at any time. Market volatility is all about safety here. We saw how, like in 2008, when the market crashed, what happened? People lost a lot of money. Americans were saying that my 401k has become my 001k. People lost a lot of money. I'll talk about what Doc Andrews calls the laser test. Liquid assets safely earning returns. So the laser test is a simple test that you would conduct on any investment that you have for you to determine if that investment is actually meeting the goals, your retirement goals. Because when you're planning to retire, when you are investing for your family, these are the things that you want. You want liquidity, you want safety, and you want to earn enough money on your returns. And of course, you also want it tax-free. Let's take a look at three investment buckets and how they affect your retirement or your investment. We'll look at the tax now bucket. The tax now bucket, you have your checking account at the bank, your certificate of deposit, your savings account. They all fall under tax now. Your tax later, tax deferred, your 401k, your IRA, your 403b, your simple accounts. In the tax deferred or the tax later bucket, the money that is going inside at contribution is not taxable. At distribution, that is when that money is taxable. One of my godfathers told me there are two myths you can never escape from. They said the first one is that you will die, and the second one is that taxes will increase. They are tax deferred, but most people ignore the fact that they will have to deal with the taxes at distribution when that money becomes a huge chunk. Let's go to the tax never buckets. A Roth IRA is a tax never bucket because the money going into the Roth IRA is pre-tax, is already taxed. So the Roth IRA grows tax-free. At distribution, you don't have to pay tax on it. Municipal bonds is a tax never bucket as well. And of course, life insurance. I talked about the 3 safeguards when it comes to investing or building your retirement nest. I talked about taxes, talked about inflation, talked about the market volatility. Let's see some factors and why I explained to this lady why her 401k was not the best place for her to have her money. We will look at the 4 retirement traps to back up our case here. And at the end, you will be the judge if it's safer for your money to be in a 401k or if you should have it maybe like on a tax never bucket or on a real estate investment. The S&P 500 historically for the past 10 years, S&P 500 has averaged about 13.6%. If you have your money in a tax now bucket, what is happening? The banks are taking this money and they are investing in the markets. They are earning 13.6%, but they are paying you 0.00003%. How can you take advantage and turn your 401k or your IRA into a tax never bucket that will give you what? Will give you liquidity, will give you safety, will give you a good rate on your return, will give you 0 taxes at distribution. Let's look at the 4 traps and why the tax deferred bucket might not be a good bucket for you. Let's take a look at our retirement trap number 1, which is a tax trap. One thing for sure is clear, that taxes will only increase. So if you defer your taxes today, know for sure that you will meet a higher tax bracket in the future because of huge government expenditures. We'll talk about that. Let's take an example here. I'm contributing $100 a month into my 401k. I do this for 30 years. In 30 years, I must have contributed $36,000. The S&P 500 for the past 10 years has averaged about 13.6%. But let's be modest. Let's use a 10%. So if you have this 36,000 and we index it to the S&P 500 at 10% over 10 years, then you must have made about $226,000 on your 401k over 30 years. Let's say you are at a 20% tax rate. Let's assume that you have a minimum tax rate of 20%. At 36,000, you must have deferred 7,200 in taxes. Some people call this a tax saving. No, it is not a tax saving. It is a tax delay. Let's also pretend that at retirement, you still maintain your 20% tax rate, which is very, very unlikely. So 20% of your 226,000 will be $45,208. So you can clearly see here that the $7,200 you delayed to pay has now gone up to $45,218. About 7 times. And we're talking just of contributing $100. Very few people contribute $100. Because your IRA will allow you, the government will allow you to put a maximum, something like $1,000 a month. So imagine the huge amount of money that 90% of Americans are dumping into their 401ks. At distribution, they got to get hit by this amount in taxes. I'm using 20% here to be very modest. Because remember, you have to pay federal income tax. Some states have state income tax. And then some people may not wait until the distribution time for them to take out that money. They may want to take out that money early and they get hit with another 10% tax. Our tax now is $7,200. Our tax deferred, which is tax later, if you're in a 30% tax bracket, then you're paying about $67,000. And if you are at a 40% tax bracket, then you're paying about $90,000. Wouldn't it be nice if you can pay this $7,200 now and withdraw this $226,000 tax-free? In 2007, the national debt was about 6.4 trillion US dollars. In 2020, the national debt is about $27 trillion. Where do you think the government will get that money to pay that debt? They have to pass it somehow to the taxpayers. In 2007, it was predicted that in 14 years, the Social Security Trust Fund will fall into serious trouble. It was predicted in 14 years that the amount of Americans, baby boomers, who are 65 years and older, will double. Therefore, there will not be enough young people in the workforce who are working to fund Social Security in order to pay the baby boomers. That's why it was predicted that by 2042, the Social Security Trust Fund will be exhausted. Where do you think the government will get money to fund Social Security? The government can never drop Social Security. That is a social contract between the government, the US government, and the people. They have to keep Social Security going. So who you think that burden is going to pass to? Wouldn't it be nice if you can pay $7,200 now, and at distribution, you take out this $226,000 without paying any tax? This is how you should focus on your retirement accounts. And this is what I explained to the lady. A lot of people live with so much assumptions about 401ks and IRAs, but they need to understand how it really works when it comes to taxes. Retirement trap number 2 is the access trap. Tax-deferred plans can only be accessed at age 59 and a half. Social Security, you start getting it at age 65. Remember, when you pull money out of your tax-deferred plan, that money is added to your taxable income, thereby doing what? Thereby shooting your tax bracket off the roof. And usually at this age of retirement, we have very less tax deductions. We must have paid out our mortgage. The children must have grown and left the house. You can withdraw before 59 and a half, but then you'll be hit with a 10% penalty for early withdrawal. So let's say, for example, by the time you get to 59 and a half, you are at a marginal tax rate of 40%. And you say, no, you know what? My son has a problem with his tuition. Let me pull out the money that I have in my 401k and pay my son's tuition and take care of some other items. You add 10% penalty. So we are now looking at a 50% tax rate. So let's go back to our example of the 226,000 on our 401k that we have accumulated over 30 years. If you were to withdraw this money at 50% tax rate, and it will cost you 113,000 in taxes. So the question you need to ask yourself, your 401k, your tax-deferred plans, is it owned by you or is it owned by Uncle Sam? Yes, your name is on it, but Uncle Sam has a 50% lien on that money. Let's say you are 59 and a half and you pull it out. You don't have to deal with a 10% penalty, but you still have to deal with a 40% you pay in taxes. That's why I asked the question before. Do you want to pay tax on the seed or do you want to pay tax on the harvest? You make that choice. So what if you found a vehicle where you can actually access this money tax-free, where you can access this money penalty-free? This is how we should be thinking when it comes to our retirement. Retirement trap number 3 is the distribution trap. On tax-deferred accounts, you must start withdrawing the money by April after the year you reach 70 and a half. So what happens? I don't need the money. I don't want it now. Must you take it? Yes, Uncle Sam is going to force you to take out that money because they want you to start taking that money out so you can start paying the taxes. IRS publication 590 of 2003, it says, if you fail to take out the minimum required distribution for that particular year, then what happens? The IRS is going to impose an excise tax of 50% of the amount that was supposed to be distributed for that year. So each year you don't take it, 50%. Each year you don't take it, 50%. And some people are not even aware of this. So wouldn't it be nice if you have your retirement nest egg, your investment in a bucket that has no minimum required distributions, that gives you the tax benefits, that gives you access, liquidity to that money, that helps you with safety and a good return on your investment? Tax-deferred accounts is not one of them. Retirement trap number 4 is the debt trap. Most of the times, when we sit with our financial planners, we talk about the historical performance of the NASDAQ, historical performance of the S&P 500. We talk about a 5-year plan, 10, 15, 20-year plan. What we seldom talk about is the fact that What if I drop tomorrow? What is going to happen? People seldom think about premature death because they always think that is going to happen to other people and not to you. It's a human feeling. Most people also underestimate how much money their loved ones will need in order to replace their income when they are gone. In a tax-deferred account, two things happen. When you die, the money in that account, in your 401k or your IRA, it passes to your spouse, still as a tax-deferred account. But if you are single, or if that money passes to anyone other than your spouse, then it is considered income, and that person has to pay tax on that money. Not only are they paying tax on that money, but their tax bracket will actually go off the roof because that money is now coming to increase their marginal tax rate. If you have your money laying somewhere and you don't have to worry about taxes, you don't have to worry about inflation, you don't have to worry about the markets going up and down, you don't have to worry about when accessibility, when to take out that money, you don't need to worry about how that money will pass to your heirs, to your children, to your relatives, then I think you'll be in a much better situation to pull money from that bucket and invest in real estate. There exist much safer buckets for you to invest, and 401k or tax-deferred accounts is just not one of them. I want to thank all of you for sharing our content. We appreciate you so much. We want to extend our sincere love and gratitude during this Christmas season. May the good Lord provide and protect you. Please don't forget to subscribe to our channel. Thank you. See you in our next video.